Welcome to economics class again, and this week we're going to go over credit and borrowing. Credit, not to be confused with credit cards. We'll go over that next week. We'll touch a little bit on credit cards. But this is to help you establish good, positive credit so that in the future, when you go to buy a car or a house or when you're renting or whatever, it gives you a better credit score, which will help you get a loan, first of all, and better rates. And like I said, we'll talk about that as we go. So what is credit? Credit is anytime you borrow money, or the lent money is known as credit. So that's why a credit card will work here. But more importantly, we're focusing on loans this week. You can borrow money from a bank or with a credit card or with other lending establishments, but be wary of the other lending establishments, which we'll hit on as at the end of this PowerPoint. But to look at credit, the credit card companies will consider what they call the 4 C's of credit to determine whether you have good credit or bad credit. The first C is known as capacity. Capacity is your ability to meet your payments. That helps when you have a good paying job, when you have had the job consistently over a matter of time. So if you're a job hopper, that doesn't bode well for you as far as your capacity is concerned. They want to see that you have a job and that you can consistently go to the job and you make decent money. When you're filling out your application for the loan, some of the questions you get, or do you have a job? How much money do you make each month? They're also going to ask you what your monthly expenses are, which goes to last week's, and you can, or 2 weeks ago when you talk about your budget. And you can answer those questions right away. You want to have what's called a positive net worth. We'll see that in a few minutes, where you're bringing in more money, obviously, than you're paying out. So that would help with what's called your capacity or your ability to make money in general. The second C is capital. Your capital is the value of your assets and, like I said, your net worth. Lenders want to know how much you make minus how much you pay out. That gives you your total of your net worth. If you're in a business, that's known as your working capital. This is actually a pretty good diagram here for a business of working capital. That means how much money you basically have available to you each month. So if you're taking out that loan, they want to see that you have right now your net worth will give you the ability to pay that money back. And they want to know that you're making more, obviously, than you're paying, or how much debt you have. So the lender may ask you how much money you have in the bank. They also may ask, do you have any investments that you make money from, or that you could liquidate if you have to pay off your bank loan. The third C is known as character. It's not what kind of person you are, even though this question, who do you trust more in repaying a loan, Homer Simpson or Mr. Monopoly? Obviously, you're going to go with the guy with the money, but that would be discrimination. You can't do that. But what they're looking into as far as your character is, how have you paid your bills in the past? Are you somebody that pays on time? Are you somebody that pays, if it's a credit card, do you pay more than the minimal amount? They want to know that you're somebody who, when you take a loan, that you're going to pay it back. I'm sure all of you have friends who, you loan money. Some will be repaying it right away. Others you may never get it. And when you're giving that loan away that you're never going to get that money. So, questions: have you had credit in the past? Now, for most of you, you don't have credit right now. Is that a good thing or a bad thing, a credit report? It's actually a bad thing. That means that the bank's going to have to take a chance on you, and they don't like that. So for you guys, what you should start doing is establishing your character now, which means getting a credit card, talking to mom and dad, getting a credit card. You can do it with a very minimal amount and pay that amount each month, which is establishing your credit, which is always a good thing, and you can never start too early establishing your credit. How many credit accounts do you have? How many things do you owe out money to? The more things you owe out money to, the bigger problem there is. Even if you have a credit card that you don't use, you could use it because it's there, and that could be held against you. So have you ever filed for bankruptcy? Most of you aren't into that, but making payments late. Make sure you're making your payments on time. That adds to your character. And the fourth one is what's called your collateral. And most of you don't have that at this point. That's what you're trying to get the loan for. But your collateral is an asset that you're going to offer to the bank. If you don't repay it, then they can collect on that asset. For example, if you're taking out a mortgage for your house, you may put up your car as collateral. For most of you at this point, mom and dad would have to co-sign the loan, and they're going to have to put up collateral as a part of that. That means that you're pledging whatever your stuff is in case you don't pay it. So they may ask you, what are your assets to secure the loan? If you don't have any, obviously it reduces the chance of you getting a loan, in which case you're going to have to probably ask mom and dad to help you out there. Now, what do these 4 C's add up to? Basically, it comes out to what's called your credit report. Your credit report, also known as a FICO score, if you hear that term, know that it's the same thing as your credit score. It's basically used to predict how an individual is most likely to pay back a loan. And banks take this very seriously. They look at your credit report. So if your credit report is 0, you don't have credit, then that's awful for you. So again, I reiterate, make sure you're trying to establish credit in some way. Getting a credit card and using it once a month and pay it right away. And that is an easy way to establish good credit for you. Credit reports vary depending on the service. There are 3 what the federal government uses as legitimate credit services. Typically, if you buy a house, they're gonna the mortgage company is going to use all 3 to check. That's Equifax, Experian, and TransUnion. If you remember, if you ever have your stuff stolen or you think there's identity theft, those were the 3 companies I told you. Make sure you contact those so that your credit report doesn't get hurt. Now, what do they look into as far as your credit report? What comes up with your credit score? That's broken down right here. Do you have any outstanding debt? That's 30%. What is your payment history? How are you good at paying stuff back? That's 35%. The other big one is your credit history. What have you done in the past? So those are the biggest 2 is obviously any outstanding debt. How many bills do you pay? And what your payment history is. Are you somebody that's reliable, or are you somebody that's kind of hit or miss when it comes to repaying? And those are your biggest 2 things that you have to be careful of as you protect this credit score. Credit scores range typically, obviously, 850 is your goal, 780 to 850. Those are your best. But really, anywhere in the 700s, the mid to high 700s is good for you, and that's where you ultimately want to get established at before you ever get a mortgage or anything like that. And I'll explain why in a minute. What good credit scores will do versus bad. The top 2 scores is probably about 20-25% of Americans fall right into those top 2 scores. Probably about 35% are in the 600s. That's bad, and probably about 40% of Americans are to average, above average. So you want to be, and this basically explains how likely you are that you're going to get a loan, and that you're going to get it for better interest rates or paying less back. So you really want to work hard to get your credit score up to that. By the way, you can get your credit score reported free to you, as we talked about last week in fraud, up to 1 time a year for free by the federal government if you go through one of those big 3 companies. Now, other places do credit scores. I would avoid those. They're going to try to get you to pay for it every year. Even those companies might try, but you do get 1 free one a year. Take advantage of it. There's no obligation for you to continue to get your credit score. You don't need it more than that. Actually, the more they check your credit score, the worse it hurts your credit. So you want to do it once a year. Make sure you're on top of it. So what is the benefit of having good credit versus bad credit? Good credit allows you to get loans at cheaper interest rates, so that's less you have to pay back to the bank. You're allowed larger amounts of money for bigger purchases. And they're going to ask less questions and throw you through less hoops you have to jump through to get a loan. Bad credit obviously does just the opposite of that. It also takes the chance that you won't get a loan at all. You're going to get really high interest rates. For housing, they may force you to get a mortgage insurance called a PMI, which is really just you're paying for them to secure the fact that you're going to pay your loan. It's really pretty awful. Even employment can be hurt. Employers now, since especially with the job force is the low as it is, the high unemployment as high as it is, job force out there, employers can be more particular. So somebody who doesn't pay their bills, they're going to see as unreliable. So it may even hurt employment. It may hurt you getting a chance to get cell phone from Verizon, stuff like that. So you really have to be very, very careful keeping that good credit score. You really want to do that. So what are some of the tips for building good credit? Starting from the beginning, working your way up. Develop a budget. We talked about that a couple weeks ago. Stick to it. Don't mess up your budget. You don't mess up your budget, then you're not going to overextend on loans. You're not going to miss payments, etc. Number 2, getting a new credit card does not mean you have more income. That just, again, means that's a security blanket, and you've earned it by getting that credit card. But make sure you're paying that credit card off every month. Don't pay the minimum payment, because then you're going to end up paying more. 3, save your money in case of a rainy day so that you're not dependent on credit. Now, this is hard to do at your age, and that's why credit cards are so important. It's just making sure you don't go into too much debt with your credit card. Number 4, this is a huge one. Pay your bills on time. Get them paid. That is always a big boost for your credit score. Keep your credit card balances low. Aim to pay them off monthly, at worst every other month. Again, this saves money out of your pocket, and again, builds your credit score. And like I told you, number 6, check your credit reports annually. It's good for fraud. Make sure you're not your identity's not being stolen. They do have sometimes misinformation on your credit card score or on your FICO score. So make sure that you check that and make sure that that is accurate, because obviously inaccuracy is going to hurt you in the long run. All right, so now that we've done our credit score, what type of loans can we get? Well, this is the bigger 3 for you guys, and yes, that is a toilet bowl house. I love that picture. Somebody actually was building that in their plans. The biggest one is obviously the consumer installment loan. This is for anything more expensive like a boat or a car. Not that most of you are getting a boat. College tuition would be considered a consumer installment plan as well. This is obviously, you guys are going to be preparing for this next year as you're going into college, getting that consumer installment loan. The good thing with the school loan is they will wait until you're done school. They will what's called defer it until then. And I'm going to try to get school loans our very last week of class. Credit cards, obviously it is a loan, but again, this is something that's going to be used in what they call a rolling loan, so this can continue to build up, but it's better to pay it off. And then finally, eventually, all of you are going to get a home loan and refinancing and home equity loans. That's all involved in your house and how much money you put into your house. And that'll be a little bit more important further down the line. So what does credit cost? As a consumer, you have to balance basically the want or needs of the loan against the fees and interest that you're going to pay. So it's a balancing act. How bad do you want it versus how much you're going to pay for it? And that's always a question, and that's one you're really going to have to debate with that credit card. Because remember, if you go past that first month, you're going to owe interest on that credit card, and all of a sudden, what cost you $100 is now going to cost you $120. Is it going to be worth that to pay that? And in the long run, probably not. So that's why you definitely want to pay it off monthly. Fees and interest also you have to be very wary of, especially if you're making late payments. They may charge you maintenance fees. You have to be careful of that. You don't want maintenance fees or service charges or late fees if it's late. So they'll add money on top of that. Those are never good things. You always want to look at also fixed interest versus variable interest. Fixed interest means it's going to be the same every month. Variable interest can rise and fall, and that can be dangerous even with student loans. And that's really what started the housing bubble, and people fell into that variable interest rate. So you want to make sure if you can get the fixed interest. And finally, like I told you, beware of any alternate financial services, because they're there. Those sharks that we talked about last week. including rent to own service, refund anticipation loans. You